This is another video in the webinar series that I'm putting on right now, and I want to talk today about charting, primarily in thinkorswim. Now, the HCSI software can do a lot of things, but you can't execute trades through it, and you can't have charts that are less than 1 day. So I use the daily and weekly charts in HCSI, and I look for buy points in HCSI because it is such a great way to do it using the indicators that we have, the 3 and the 6 crossover, volume point of control, pocket pivots, etc. But when it comes to breaking down a chart for time frames under daily charts, that's when I move the stocks or load the stocks into thinkorswim. Now, these are the stocks as of Friday, the 26th of May, that passed the new filter that I put together about the strongest performing stocks. You can see there's only 28 of them. Now, what I'm going to do is I'm going to copy these to the clipboard as a comma separated list, and then I'm going to go to thinkorswim. I'm going to click on watch list. I'm going to edit the watch list. I'm going to import. I'm going to paste these. You can see the symbols are here. I'm going to replace the current symbols, save that, and these are the symbols that are in the strongest stocks list. Now, this is a daily chart, this is a weekly chart, this is a 78-minute chart, and this is a 16-minute chart. Now, I've had a question, why do I use 78-minute charts rather than 60 or 65-minute charts? Because these are what we call fractal charts. These charts build upon one another. And to explain that, I'm going to open up my drawing tools, and I'll get an arrow, and I'm going to point to this weekly chart. This weekly chart, if we go into the daily charts, it's made up of 5 daily charts. So these 5 charts, or 5 bars, I'm sorry, are represented in the weekly chart over here. And then if I move down to a 78-minute chart, 5 bars in the 78-minute chart, so it would be this bar down through this bar represent the daily bar, or they're built, and the final product is a daily bar. And then I go to a 16-minute chart. Now, 16 minutes doesn't work out exactly to 5. In other words, it should be 15.6 minutes, but I can't do that in thinkorswim, so I'm using 16 minutes. So 5 of these candles with the 16-minute chart equal 1 of the 78-minute charts. So it builds from the inside out. In other words, it takes 5 of these 16-minute bars to make 1 of the 78-minute bars, and then 5 of these to make 1 of these 5 daily bars to make a weekly bar. So we can actually see the build now. The way fractals work is usually the longest term chart is the dominant chart. So the weekly chart, if it's going up, it's the dominant chart. If it's going down, it's the dominant chart to the downside. So when you're looking at these 4 charts on the grid, it's always best to look to see what the weekly chart is doing first, and that may give you an idea of what the daily chart is doing, or the 78-minute chart, or the 16-minute chart. You can see if the uptrend is continuing. Now, if it starts to change, it's going to start to change, of course, in the slowest chart, the 16-minute chart. So if the 16-minute chart starts breaking down, then the 78-minute charts will start breaking down, and then the daily chart, and then the weekly chart. So change always happens from within in the smaller time frame. So you watch that for changes, but you really can't make a determination on what the longer term charts are going to do, but you can start to see if there is some weakness beginning in a chart or if there's strength beginning in the short-term charts and then building into the longer-term charts. Now I'm going to go back to HCSI Charting, and I need to clear the screen of those arrows. And what is this? This is Meta. Let me see what else is in here. I'll just sort over here. Symbol, it's already sorted on symbol. Let's take a look at AMAT, which has been moving up sharply. The weekly chart, if I start over here in the weekly chart, this goes back to the week of January, or the month of January on the 9th. You can see at this point, here's a pivot low. It formed a higher pivot low here after the third higher high on the weekly chart. So the trend has been up since then. If there are three higher highs and the third higher high began, here's the first, here's the second, and the third began right there as this high was taken out, I know that the weekly chart is in an uptrend. For that trend to reverse, I'd have to have three lower lows. That didn't happen here, so it stayed in an uptrend in the weekly chart. Now the daily chart, let's see if I have a longer term daily chart here. That's 1 month. Let's take a look at 6 months on the daily chart. I'm going to go back to the week of 1/9. I believe this is it right here. That's 1/6. Here is 1/9. And if I zoom in on that, you can see that there was a test and then an up arrow. This is a daily chart here, and you can see there was buying, but it closed in the lower part of the range. But the following day it opened higher, and sellers came in there again. But each day the pivot or the low was a higher low as this started to trend up. So these 5 bars right here represent this bar. If you look down at the bottom, you can see that it's a 9th. So 1, 2, 3, 4, 5 bars represent this bar, are represented in this bar, I should say. So the daily bars are building the weekly bar. Now I can't go back that far with the 78-minute chart, but just remember that this is the dominant chart and followed by the daily chart. But if I zoom out on the daily chart, you're going to see lots of ups and downs on the daily. But here is, let's see, that's February 13th and February 20th. That's probably represented in here, right in here. So these candles right here as it retraced are represented right here. So the fractals of these weekly bars are represented in here. So we had, if we use the 3 lower lows, we had a change of trend on the daily charts. And it didn't change back up there because I don't believe that high here was higher than that one. But anyway, it came back down and tested this, and then we had the 1 higher high, 2 higher high, the 3rd higher high began right here on the daily chart. But the weekly chart was not influenced enough to turn negative. So if you can hold on through these, and it's tough to do, the trends have not changed. But this is the beauty of looking at fractals, because you can see what caused the weekly bars, and it's this series of daily bars coming down and then finding support, and then there's a test on the VPA flag here, and it starts taking off again. And these 78-minute charts are representing this daily chart. So 5 of these will be right there, represent this last daily bar chart. Going back here, what is the date on this? Oh, the time is 8:30 and the date is May 25th. Let's go back here and take a look at this. This is 426, it looks like. Now I'm going to go back to the HCSI chart, and I need to bring up AMAT. Bring this down. I'm looking for 426, would be right here. This is where it's finding support right in here. That's 426 on that day. And there were 2 VPA flags on that day. Let's make this full so you can read all this. Strength seen returning after a downtrend. High volume up bar closing on the high indicates strength right here. And then there was a confirmation of that strength the next day. And up bar closing near its high confirms the return of strength. Now the 3, it looks like it was, let me zoom in on this, see if we can figure this out. So on this confirmation day here, it looks like the 3 was crossing the 6. If it didn't, it certainly crossed the next day. The histogram shows it right here, but it could have been, well, it's there. If you, as I move this, you can see that little green bar. So this would have shown up in my scans either on this day, well, this day right here. There's a 2-day window, and it would have pulled back, and then it showed up again right here on this effort to rise. It looks like at the same time the group was starting to move, and then it pulled back, and it kind of pulled back in here too. But going back to this, you can see that the 10-period volume point of control had turned positive back here on these candles, and volume pocket pivots also appeared on these 2 days. Then there was a digestion period. There is a no supply at this point. Why? Because look at that volume bar on the no supply. There's no selling. And then what happened the next day? Volume came into it. Now looking further to the right here, you can see that there was a low established there, another low here, and this was a third lower low on that gap down. So if you follow the third lower low rule, but there was actually a pivot price change before that, because here's the high pivot, and then the confirmation of that pivot didn't really take place until this one was filled, and that's way too late because of these big bars. So that's not a good example of a pivot. So just disregard this. Now here is your spinning top on the 18-day exponential moving average, and then this is when the big rally began. Well, didn't begin there, but it continued on Thursday and Friday, and the earnings actually, that was a dividend day right here, 32 cents, not an earnings day, and I'm not sure when the earnings day was on Applied Material. But we can find out by going back into thinkorswim now. I need to get back on AMAT. Let's see. Okay, now AMAT, the earnings came out here. $2. Looks like there was some anticipation of great earnings, and then there was the selling, and then on Thursday, the gap up as the semiconductor rally continued. You can see the gap up here on the 16-minute chart, the gap up on the 78-minute chart, the gap up on the daily chart, and 5 days, 1, 2, 3, 4, 5, is representing this bar right here, the high and the low. So that's using fractal charts. Just remember the longer term usually dominates, but not always. I'm going the wrong way here. This is why high relative strength stocks are often the best stocks to buy, because they already have momentum going. When they pull back and then start moving up again, those are the lower risk opportunities that we want to take advantage of. This is on the long side. Just reverse it for the short side. So I'm going to bring up HCSI Charting one more time. And you can see right here, this is extremely low risk because there is support across here. This is intrinsic risk where there is support on a moving average. It's on the 200-day moving average and it's holding on the 200-day moving average. Here it's holding on the 100-day moving average. Now every trade obviously is a random trade, but when you start seeing support based upon moving averages or just support and resistance lines and also a bunch of VPA flags coming in, that's a pretty good indication that the intrinsic risk is low. And then you look at the context, the moving averages. That is your contextual risk. What's the risk here? Well, the risk is it's moved up a lot. You can see a little bit of selling in that bar. And when it moves up this quickly, often it's going to pull back with profit taking. Now, in this week's live webinar, I'll be doing a lot of talking about charting and HCSI and thinkorswim, how we can use them in conjunction. I'll be talking about fractals and also intrinsic risk, contextual risk, and setup risk. Thanks for listening.